Hey everyone, welcome back to another lesson. In this lesson, lesson 10, we're going to be talking and introducing balance sheets. So in our previous discussions, we really stayed at a high level and examined how the economy works as a whole, some of the interesting principles that apply to it, and also how entities may interact with one another. Now we really want to get more detailed in those interactions and entities and understand how they work. And to do that, we're going to need a mental model for each of those entities. And that's really where balance sheets come into play. Those balance sheets are just simplified representations of those entities, and they show what we're interested in, which are assets, liabilities, and equity. Those are the three key components in a balance sheet. And balance sheets are just one of the three fundamental accounting financial statements of interest, the others being the income statement and the cash flow statement, which we will cover in subsequent videos. So for the balance sheet, as is in the name, it is a statement that must balance. And the accounting equation is that the assets must equal the liabilities and equity. And we'll talk more about exactly what that means. In general, a balance sheet is often described as a snapshot in time. So if you were to just freeze and look at what an entity owns, its assets, what it owes, its liabilities, and the net of that amount, its equity, that is what a balance sheet is trying to capture. So in general, assets are things that can help generate cash, or it's cash itself. Assets are things of value. So why are they valuable? Because they are cash, so you can use it to buy things. And there's flexibility in what you can buy. Or it's something that generates cash, so that obviously has value. And if that's valuable, you can also sell it, and that's valuable as well. So those things are all assets, and we typically list them on the left side of a balance sheet. This is a T account for an entity. We list the assets on the left. And what are liabilities? Liabilities are things that you owe to people, generally some sort of borrowing. So we have talked about lending in the past. A loan is a form of borrowing, and that would be a liability. And then equity goes by many names. It can be thought of as the net worth, or the difference between the assets and the liabilities, or outright ownership, the amount of ownership. And so there can be some examples that might be helpful for people to understand. So just thinking about a person, for example, and seeing how a balance sheet might balance. Imagine that you are earning a salary and you have wages coming in. And every month you have a certain amount of cash. Let's say you earn $100. And I take a snapshot of that. At the end of the month, I want to see how much cash I've earned. Suppose it's my first job. And I've earned $100 at the end of the first month. What I would see is cash of $100 here are my assets in cash, and then an equal amount in my ownership, because I own that cash outright. So that would be $100 in equity and $100 in cash. And so we're still good here. The asset side equals the liabilities and equity. The two sides of the balance sheet balance. And so this all makes sense. I own the $100 outright. Now, suppose through the passage of time, before I take another snapshot to look at what my balance sheet looks like, I have gone to the bank to get a loan. I need a student loan to pay for college, perhaps. And so the bank is going to give me a loan, let's say for $500. Well, that is a liability, right? I go through and I understand, okay, I owe the bank $500. So here, this would be a $500 bank loan. But at the same time, the loan also creates an asset for me. I have additional cash that the bank has given me for my current use. And so now I have $600 in cash total, 100 of which I owned outright, and 500 of which I owed back to the bank. So from this example so far, we can see that the right side of the balance sheet can be thought of as a funding source. You can raise money either from your own income, your own work that you own outright, or you could borrow money, and that's also a source of cash or a source of funds, right? If you're a company, you can raise money from outside investors as well, and they will take a percentage ownership of the company for the cash they give you. Or you can earn equity and cash from your earnings that you generate throughout time. So we have our snapshot here, and the cash portion here is not static. So let's say throughout some period of time before we capture our next balance sheet, we've spent some of that cash. I am studying something in college and perhaps I need a new couch in my dorm room. Maybe that costs $300. So I've spent some of that cash. Instead of the 500 now, I only have 200 here. And now I have a new asset, 300 for my couch. So as you can see, the amounts can change on the asset side, on the liability side, and between them. But however the assets and liabilities and equity change throughout time, they must always balance. So that's kind of the general principle, and I encourage you to draw up a balance sheet of your own that lists out things that you own, whether it be outright cash or perhaps you own stocks or any other assets, and then also list out things that you owe people and calculate your net worth. I think that is a good exercise. And on the bottom here, I have drawn out some of the entities of interest that we've met before and filled out some example balance sheets of what they may look like. So we've been talking about the individual here. In my example here, the individual owns a $100,000 house and $20,000 in cash, and they had taken out a loan from the bank, which was $50,000. And so if I do the subtraction of $120,000 in assets less $50,000 in a bank loan, that implies this individual is $70 of net worth. That means if the individual sold the house, converted it to $100,000 in cash, which is what it's worth today, that $120,000 in cash could immediately be used to pay down $50,000 in the bank loan, and he would be left with $70,000 in cash, exactly matching the $70,000 in net worth. Moving on to the business, a business may have $50,000 in cash, $200,000 in equipment, which is generating cash. They're using equipment to generate more and more cash for the owners. It has taken out $100,000 in bank loan, so I subtract my $250,000 in assets less $100,000 in a bank loan that I owed to the bank. That implies this business has an equity of $150,000. Here I've drawn out a government. So the government in this case has $1 trillion of cash and $1 trillion of loans that it's made to people in the economy. And to fund those assets, they have issued $20 trillion in bonds or borrowings from the public. And to make it balance, again, I do my subtraction, it's a minus $18 trillion deficit. So that means future generations will need to be taxed in order to pay back all of these bonds and make up the deficit, since the government does not own enough assets outright today to make good on all of the payments. So it is borrowing against its future, against the future productivity of the nation. And another entity we looked at is the Federal Reserve. And so they own assets, $5 trillion in bonds per se, $1 trillion in loans, and their liabilities and equity, they have 5.9 trillion of reserves per se. These are liabilities of the Fed, but they will be assets of the banks. And then there is a little bit of equity, 0.1 trillion. So these are example balance sheets across the spectrum. Now, one thing to note is an accountant's view of the balance sheet is purely historical. So there are really two kinds of balance sheets we are interested in. An accountant primarily cares about what has happened in the past. And so they are documenting every transaction that has happened leading up to the balance sheet as it is today, kind of like what we were doing in the beginning, momentarily taking snapshots every quarter or every year to look at how the picture has evolved. And they would count up all of the cash that has come in and out of the company, whether it was earned or paid out or raised from investors or borrowed. And that would be their definition of a balance sheet. However, there's another important balance sheet, and that is the market value balance sheet. And in finance, different from accounting, we are primarily concerned with the market value balance sheet, which instead of looking purely historical, instead of just being book value, right, historical also known as book value, we care about the forward projections, the cash that could be owned, and that is the market value. And so this is more of a fickle item. It's very easy to know and look and see what has happened. It is much harder to predict what will happen in the future, but that is what a market value balance sheet reflects. The value of things currently if it were to be sold in the market. So what does that mean? That means an individual's house is $100,000 today if it was appraised at that value. That would be the market value. This $100,000 house also had a historical or book value. And that was what the individual purchased the house for back in the day. The market value is constantly fluctuating. So if the house were to increase in value, I don't owe any more to the bank. That means my equity increases, because if I could sell the house and get the cash at the market value, I make the same $50,000 payment back to the bank. I'm free and clear, and I own the rest of the cash outright. However, if my house falls in value, then that directly affects my equity, my ownership value, because if I were to sell the house at a lower value, I still owe $50,000 to the bank, but my equity is lower. So in that sense, the market value is more flexible because the historical book value of that house was just whatever I purchased at, and that will not change. And so this concept will become clearer as we build out the other statements, but this serves as a great introduction to balance sheets. And I'll see you in the next lesson.